Hello, everyone. This is Rachel Deschelle here, brand new Schwab coaching coach here. I'm actually joined by Cam in the chat today. Please chat in your questions and comments during the session today. We may even have a survey dropped in the chat as well. We may even go through just kind of the survey and make sure you pop that in the chat there. Follow us on X, Cameron May CS and Rachel Dash CS. Subscribe to our Trader Talks channel on YouTube. And today we are going to cover just how to search for technical setups and find support bounces with trading long options. So stick around today, but first, before we dive in, we're going to cover a couple different disclosures. So first and foremost, options carry a high level of risk, are not suitable for all investors. The information that we're going to cover here is for general informational purposes only, should not be considered any type of recommendation or advice. Schwab doesn't recommend the use of technical analysis as a sole means of research. You definitely want to do all your research, including fundamental analysis as well. Now let's get into the agenda. So we are going to discuss the concept of long options today, do a little bit of a market overview, review the trades that we placed last week. We're going to discuss some concepts of price, time, and volatility. We're going to go through how to search for some of these setups with long options. And then we're going to get through placing example trades on the Paper Money platform. So let's dive in and do our little bit of a market overview here. Excuse me. So first, just starting with the Dow, we've had a little bit of a pullback in the last few days. We broke through the 20-period simple moving average, but we're still holding major levels of support here. So I zoomed out on the 1 year, 1 day, just to show this major horizontal level of support there, which is right around 45,000 or so. But if I look a little bit closer, we can just see some of these areas that have been violated and we're trying to kind of bounce back from. So we saw on, Friday, we saw that huge sell-off where we found the 50-period simple moving average as support there. We crossed above the 20. Now we found it again today, and we're kind of battling back towards that 20-period simple moving average. So a lot of volatility that we're seeing in the market. Markets are somewhat flat today, but let's look at the NASDAQ as well. Now, similar thing in the NASDAQ, we closed below the 20-day simple moving average, but we held this horizontal level of support here. I would say right around 22,200 as that horizontal level. We can see it's been touched multiple times here. We didn't go so far as to retest the 50-day moving average there in blue, but again, we're battling once again with that 20-period simple moving average there. We have a decline in momentum, but it still remains above that 50 level that we see there on the RSI, still kind of showing that bullish regime for the NASDAQ. Now, let's look at the S&P 500. So we saw kind of the same thing here with the S&P 500. We saw that break of that 20-period simple moving average, and then almost retesting that support at the 50-day moving average, but it's testing that horizontal support that we saw was touched a few times here, right around 65.45, and it even kind of got near that range again today. But once again, battling with that 20-period simple moving average that we see there, just trying to climb back there. Now, since we talked a little bit about the volatility, let's just take a quick look at the VIX here. And I'm going to add another moving average onto here. I'm just going to show our 200-period moving average in the VIX. And I think this is somewhat kind of important when looking at this chart. We can just see in periods of elevated volatility that VIX tends to move above its 200-period moving average or 200-day moving average here. And we saw that move on Friday, again yesterday, and again today. So that VIX remains elevated around that 20 level or so, which actually equates to about a 1.25 move in the S&P 500 on a daily basis. So kind of telling us that we may see some volatility here in the near term unless that kind of pulls back under its 200 period moving average there. And then lastly, when looking at the markets, I wanted to take a little bit of a deeper look into just looking at a little bit of market breadth here. So here we have one chart that shows 4 different things. So in the first quartile here, we're seeing the percentage of stocks above their 200-day moving average. And it still remains bullish in the long term because we have over the majority of our stocks above their 200-day. So we have about 61% of stocks above their 200-day. The picture looks a little bit different when we're looking at the percentage of stocks in the S&P 500 above their 50-day. And we can just see this declining trend line there, just making lower highs, lower lows. And we're actually we're in the minority there. So we're about at 48% of stocks above their 50-day moving average. And typically before a little bit of a market pullback, a little bit of a decline, that's kind of what we see in market breadth, is just that kind of decrease in strength there. Now, looking at New York Stock Exchange new highs and new lows, typically what we see in a correction or a little bit of a pullback again is just stocks make less and less stocks making new highs and more stocks making new lows. We're not really seeing a huge pickup in new lows like what we saw in April and in March. So this isn't kind of lending itself to a correction yet. Obviously, we kind of showed it's finding support at that 50-day moving average, but this is something you can use to look a little bit under the surface here. So let's transition into looking at some of our trades that we placed last week. We placed SATS, which still hasn't gotten triggered yet. It's still waiting on our condition. So we're going to kind of keep that one in our back pocket. Now, the other one that actually did trigger last week was MET. So we're down a little bit on that one, and we can look at the technical setup here in a moment, but we still have our stop in place. We still have our profit target in place should it bounce. We're seeing a little bit of a bounce today, but let's just look at the technical setup that we had for MET. So remember we saw that, and I'm going to hide this study here so we can see price action. Remember we saw a little bit of a head and shoulders pattern taking place with the left shoulder here, the head right there, and then the right shoulder. We saw a little bit of a breakout, which we saw our confirmation, which we initiated that trade on, and then Friday with the sell-off, we were just brought back in there. So could have been a little bit of a pattern failure, but then today we're kind of working on a close. We'll have to see where we end today, but could be a close above the high of the low day. So it could be a little bit of a hold with the price action here. We did have a bullish engulfing, very big bullish engulfing candle that's taking place at this pivot low here. So we're just going to hold on to that onto that trade a little bit to give it a little bit more time to see, since we obviously have a couple months in time. Now, let's take a look. Oh, I have a question in the chat. Could you share that chart? Was that the market breadth chart that we were looking at? Yes, I can share that here. So let me pull up the link and I will paste that in the chat for you. Market breadth. And there we go. So that's that market breadth chart. I just posted that in the chat there. Now, let's take a look at some example trades that we may place today. And I told you in the beginning that we are going to actually look at just a little bit more of the process behind the scenes on how I'm finding these technical setups, how I'm finding these trades. So we'll get to that after the first trade that we look at, but let's look at COF. So that is Capital One Financial. And something that kind of stuck out to me when looking at this chart here, we saw a level being touched quite a few times, even on Friday with the sell-off. So I'm going to zoom into this level of support that we see here, which used to be in May, was that level of resistance where we had a little tiny cup and handle pattern there. We went back for a retest, just retested again, and even had a little bit of an inside bar day, which is showing that which is showing that pause, a potential reversal. And in this case, it looks like it was quite a bit of a reversal or a support bounce because we're seeing a hold pattern taking place. So market's not closed yet, obviously, but it's trading well above the high of the low day. So we could be looking at a little bit of a hold there. So this is one of the trades that I'm going to look at for a long call. Since it held support, it's showing a bounce from support. After today could be a confirmed bounce of support. I'd be looking to place a directional trade saying that we could be going up from here. So I'm going to look at a long call option. So a couple different things that I want to look at as far as just maybe could impact the price of the option and some of those factors is volatility. And we talked about this last week in a little bit more depth, but I'm just going to add implied volatility onto the background of the chart, hide the RSI for now. And I can definitely see it's been a period of low volatility and it's kind of switching to higher volatility here. We're seeing it creep up with that breakout, which is typically what we see when price pivots, makes a major move there. So we're having a little bit of influx and implied volatility, which isn't great when we're buying options, because when we're buying options, we want to search for stocks with lower implied volatility, just because the price of the options are going to go up when volatility goes up. So a couple considerations that we're going to look at when we pivot here to the option chain here. So I'm going to go to trade all products, and I'm going to take a look at what the current implied volatility percentile, because we talked about last week how the implied volatility percentile basically takes that chart that we just saw in the last chart. So it takes the entire range of implied volatility levels that we've seen for Capital One Financial over the last year, and it's going to put that on a ranking system to compare today's level of volatility compared to where it's been over the past year. And it's telling us that it's in a 32 percentile. So it's still in the lower third. It's higher than it was just a few days ago, but it's still in the lower third there. So what I may be looking for is I may be looking to give myself a little bit more time on this option, just so it's not as sensitive to changes in implied volatility. And I'll show you what I mean here. So if I looked about a month out from expiration, let's just say I looked at the 21st of November with 38 days left till expiration, I can see, and I'm going to collapse this sidebar here so we can actually see these column sets at the top. I have the Greeks, I have volume and open interest, because those are some things that we're going to look at here. But you can see the at the money option for about a little over a month out is going to have a vega of 28. So that tells me V for vega, V for volatility. It's the quickest way. I always remembered that one. A vega of 28 is going to tell us that if volatility goes up 1 percentage point, the price of my option is going to go up 28 cents. So it's going to go up from, let's say, 870 up to close to $9 theoretically if everything else stays the same. So that's kind of that sensitivity to implied volatility. It's obviously going to be higher for at the money options, but let's just look a little bit further out in time. And let's look at the 16th of January, 2026, the start of next year. And we're actually seeing a little bit more sensitivity to implied volatility out there as well. So, and that's typically not something that you see with a stock. Typically, they're going to have a lower sensitivity to implied volatility there. But what we can look at, let's take a look at this 19th of December here in this case. So it's a little bit lower. We can also take a look at a couple other factors here when choosing a strike price. So I may want to look for a little bit of intrinsic value in the option. So I may be looking at a 210 strike, for instance. So that gives me a spread of 1630 by 1670. We're seeing quite a bit of volume in that contract today. We're seeing quite a bit of open interest, and volume's just the number of contracts traded throughout the day. Open interest is just open contracts that are open in the marketplace that haven't been exercised, haven't been closed out there. Now, I saw a question in the chat about an upcoming earnings announcement. Great question. So let's take a look and actually just put that on our chart, because that's something that I flip back and forth to on the chart to make sure I can view those corporate actions. I'm going to go to equities, select show corporate actions, hit apply and OK. So that's also another reason why we're having that influx and implied volatility. So we have earnings. If I hover over it, earnings is going to take place really next week. So that's also why we're seeing that increase, because right before a possible earnings event, Fed announcement, whatever it may be, that's some type of uncertain news that's going to impact the stock, we're going to see an increase in implied volatility. We saw that leading up to earnings here back in April, obviously with that sell-off. We saw a little bit of an increase there back last in January as well. So that could be another factor that's obviously going to impact the price of our option. Is leading up to earnings, we may have more elevated prices of the options. So just kind of keep that in mind, because after that earnings announcement, traders typically run into something we call vol crush, which means even though you could be directionally right on the option, so let's say I bought a call and the stock just blew their earnings announcement out of the water, the stock traded up the next day, but let's just say I bought this option the day before earnings when volatility was really elevated. Well, I may still be even at a loss in my option just because that uncertainty is baked straight out of that option price with the news being out about earnings. And so volatility tends to decline, it tends to crush. And I'll actually show this on another page too, just so you kind of get a little bit of an idea. You can take kind of take that into the earnings tab within Thinkorswim and look at just the levels in this grid of implied volatility going into earnings. You can just see how it's been elevated, and right after the earnings announcement in the middle of this little column here, it just sharply declines. And that's going to impact the value of your option, because when volatility declines, the value of your option is going to decline. So in that case, when it comes to just timing the options trade, you want to be cognizant of that, because that's going to probably happen a couple weeks leading up to earnings. So for this case, we're still about a week or so out from earnings. And because of the technical setup, because the levels of implied volatility, I'm still going to go through and place this example trade. But I wanted to make sure you are aware of that. And that was a great question there. So what you can do is go a little bit further out in time. So that's what I'm going to do here, looking at the 16th of January. And I'm going to select, let's say, I was going to go to 19th of December, because we identified that strike of the 210 where we had a little bit of intrinsic value. So with each dollar move in the stock, we're going to have a 61-cent move on our option. So we have about $5 of intrinsic value as well. We have a tight spread on the option here because of the liquidity within the option. So I am going to set up the trade for this one and right click on the option, go to buy custom with OCO bracket. Now we're going to select our entry as the midpoint of that option. Now you may notice the price of the option still is trading from 1620 to 1670. So I want to try to catch the middle of that spread. Now you're not guaranteed a fill at that price, but that is a price that I could start my order at and then back it out towards the natural at 1670 if I don't get a fill, if I want more control over the price. Or if I'm just looking for the speed of execution, I can start with a market order. So I may actually do that today and take a look there. Now, when looking at my technical setup here or my order setup for Capital One Financial, I want to look for a 200% gain here on this option. So if I want to look for a 200% gain, I could just take this amount times, I guess 100% gain is what I'm looking for. So I'm going to take this amount and just take it times 2. So 1745 times 2, that will be 3490. And that's going to give me my 100% profit level, which is what I'm looking for. So I'm going to make that order good till canceled. I'm also going to place a stop on the downside of my option. So in this case, stops are one way that you can manage risk on your trade. We're going to use a stop market order. Now, there's going to be no guarantee where this order is going to get filled at, but we're going to say we are willing to take let's say just a 50% loss on the option. So I'm going to take 1745, which is that midpoint, divided by 2, and that gives me 872 on the option. Now, that's just going to say that when the price of the option hits 872, we are going to send a market order. Now, there could be a couple risks with that. We don't know what the price of the option is going to be when the price of the option is that price or hits that price for our trigger. So you could use a couple different things. You could always use like a stop limit offsets, trailing stops as well. So many different types of stop orders that you could use there. And then another thing that I want to kind of take into consideration when we're placing this trade, and we covered this quite a bit on the last webcast as well, is just kind of looking at our trade size and double checking that as well. So our account value is worth 127,000, and I don't want to risk more than 5% of our account in a trade. So that gives me a little less than 6,400 that I could risk in a trade. So that is, we're, I guess, safe in that regard when we're only spending about 1,600 in this case. And then we don't want to risk more than about 1% of 1% of our account in the trade. So I'm going to take our 127,000, multiply that just by 1%, or just move the decimal and you get 1270. That keeps us well within our risk parameters there. So this is going to be a market order, good for the day. We have our upside and our downside here, which is our 100% profit, 50% stop. So I'm going to confirm and send, just double check everything. We have our first triggers, one cancels the other. Perfect. Everything looks good to me. I'm going to hit send here. Perfect. I have a position there. Now, since we placed our first trade, I mentioned just kind of showing the scan that we could do, or possible scan idea on how I'm finding a few of these technical setups. Now, you can take any bit of this into your own process as well, but I'm just going to move over to the Scan Stock Hacker and look at a few different things here. So the first thing I wanted to do was scan within the S&P 500. Now you can scan in the NASDAQ, you can scan in all listed stocks, however you want to look there. Another thing I wanted to make sure I did was place a price minimum on the stocks and the options on which I'm looking to trade. So I don't want too cheaply priced stocks, because then the capital efficiency really isn't there on the options in that case. So I'm going to look at least $20. I'm going to add another filter using a study filter, and I'm going to look at volume, because the more liquid the underlying shares are, likely the more liquid the options are. So I'm going to start with a minimum of the 50-period moving average being greater than 1 million. That's going to give me some of the most liquid stocks there. I'm going to add another filter, and this one's going to be for volatility. So I'm going to go down to volatility, and I am going to select IV percentile since we talked about that a little bit. And in this case, I just want to look at an IV percentile from 1 to, let's just say, 30. And in this market right now, just because we had that aggressive sell-off on Friday, we still have an elevated VIX. A lot of the S&P 500 is going to have a little bit more of an elevated implied volatility percentile. So I'm raising this to about 30% just to kind of catch really within the lower thirds of implied volatility. So I'll just show you how many stocks meet that criteria once this loads here. So this is giving us 77 different stocks that meet our criteria. Now, something I looked at for this morning when I was running this scan and prepping for this webcast, I looked for something that technical traders may be looking for in a support bounce or a technical setup for the underlying stock. So I actually added a filter for studies, and I looked for a RSI crossover, because when the RSI, or when that relative strength index, and I can pull it up on the chart here, let's kind of show it real quick. There we go. When that crosses above the 70 line, it's considered overbought. When it crosses below the 30 line, it's considered oversold. But the signal for a lot of traders doesn't come until it crosses back below that line on this overbought sign, and doesn't give them a signal until it crosses back above that oversold line. So I was looking for a signal, maybe a support bounce of RSI crossing above 30 coming to the upside. So I'll hop back over to the scan, and I'm going to say RSI crosses above 30 and searching for a support bounce. Now that gives us a couple different results there. Obviously, that's just one way to do it. Another thing you could look for, that I look for, is some bullish candlestick patterns, and I search for some of those to then get my little list of stocks on this output. And then I just cycle through the charts in that case and look to see if any of those price patterns are occurring at levels of support and resistance. And same with this technical indicator. I just found it was kind of showing those levels at support. So we had a little bit of a support bounce and a hold there. Okay, so let's take a look here. And I had a question about the difference between market, limit orders, and things like that. So I'm going to go back to the trade tab and just kind of pull up an order just to go for an example through our order types here. So let's just take a look at a limit order on an option, or I guess we're just looking at the stock in this case, just to kind of do a quick run through of order types. So market order, that's going to be, I guess we'll go through the stop orders in this case. So a stop market is just going to act as an activation to activate a market order. So if you're going to put in a price and say, I only want to buy it when it's above 220 in this case, that order is going to wait and be held server side until the price of the stock hits 220. Then it's going to send a market order to the market. Let's go over a stop limit in this case. So let's just say we're long this stock or long an option in this case, and we want to get stopped out when it goes below, let's say 210. So we're going to have two prices here, if you'll notice. And in the name, stop comes first, limit then comes second. So we're going to have first our stop that's going to get activated, just like that other order. But we're going to have a limit order that gets sent on that stop activation, or I guess after that stop activation, to where we can have a little bit more control over the price. So a lot of times I've seen traders actually place this at the same price as their activation. I want to let you know a little bit of the dangers of that on both the stock and the option. It's usually generally a little bit safer to give yourself a teeny bit of a buffer, whether that's a few cents or just whatever that is that you're going to feel safe with. I'm just going to go with 209.90 in this case and place the limit order a little below the stop price, Because if that stop gets activated and on that tick we hit 210, and let's just say we still had that limit at that same price of 210, but that next tick after the stop is 209.99. Well, we just had that price of the stock blow past our limit price, because our limit price is up at 210 and says we have to sell it at 210 or better. So if you kind of want to give yourself a little bit of a buffer to say, if there is a downtick after that first stop or after that activation price, we're going to work with just kind of putting it a little bit below. It will kind of catch it in a down moving market if that next tick is a little bit lower. Now, lastly, let's go through the trail stops. So it's going to kind of work the same way as is almost like a dynamic stop. So the other two, we're placing a price. These ones we're doing a little bit more of an offset in this case. So we're either offsetting it in dollar value or we're offsetting it in percentage value. So this is saying, let's say we are long this stock, for example, and we want the price of our stop order to follow up or trail our stock as it goes up. And then as soon as it goes down, let's say 5%, we want to get out immediately with a market order. Well, that's where we would use that in that case. Now that order can only move closer to price. It can't move away from it. So it, in that case, protects your losses and even protects your profits because it follows your price on the way up. Trail stop limit, similar, but the trail stop limit, you're going to send a limit price after that trail stop is activated. So you don't typically a lot of times know what price that's going to be activated at because your stop is dynamic. So a lot of traders will actually change this link from linking it to a manual price to linking it to the mark, which is similar to what we have that trail based off of. And they may put that limit as maybe 10 cents below, giving, again, a little bit of a buffer to still have control of the price to catch it on that next tick in a down moving market. So hopefully that helps there. Now, let's cover another quick example here on just kind of another support bounce that we're seeing. So we're going to go through this one pretty quickly, and this is BX Blackstone. I saw a similar pattern kind of develop. We had a little bit of a inverse head and shoulders here earlier in the year, which crafted out that neckline of support. We had a little bit of a pullback, obviously, to that support, and today we're seeing a hold pattern taking place, similar to what we just saw in the last one. Let's check a couple different things, though. Let's check implied volatility to see where that level is. And let's check to see if we have any upcoming earnings announcements. So again, we have one coming up next week. We've had elevated levels of implied volatility. So just things to keep in mind as you are crafting this strategy for the option. Let's go to the trade tab and take a look here at which kind of one we're going to choose here. First, we can see the IV percentile while it's still elevated. So keep in mind we have upcoming earnings announcements taking place. We see an increase in implied volatility with that support bounce. That IV percentile is only 27. So we're still almost in the lower fourth of where implied volatility has been over the last year or so. And so we're going to look out a little bit further in time in this case, just like we did in the last one, just kind of past the earnings there to give ourselves a little bit more time on the bounce. So let's look at the 16th of January. And just like we did on the last one, let's take a look at just an option that is in the money, has a little bit of intrinsic value, also has a decent amount of open interest. And for this one, I'm going to look at the 150 strike. I have light volume today, but I do have quite a bit of a tight spread, still less than 10% of what that option price is. So that's kind of what I'm using as a guideline for that tight spread. And so this one is about $13 of intrinsic value here. we have about a 72% chance that that option is going to expire in the money. We have about 6 cents in time decay that we're going to see on that option. So we've given ourselves enough time. We're not going to have a ton of time decay until really that 35, 45 day out mark. So that gives us a little bit of time for this support bounce to possibly take place. And I'm going to use the same setup that we did for the last one. So I'm going to go to buy custom with OCO bracket. I am going to stay within my risk parameters of one contract. And let's just say we're going to start our price at the midpoint this time, since we have a spread of 1910 to 2090. And with our buying a call here, since we are bullish, we're going to take a, let's say, 100% profit. So let's put our price at $40 on the upside. Let's make this order good till canceled. And our stop on the downside, let's just say we only want to risk half. So if this goes down 50%, which would be at $10, easy peasy, that will be our stop price. So again, we are bullish at that level of support. So we are going to buy a call. We're still going to keep in mind implied volatility, any upcoming events. We gave ourselves a little bit of time for this support bounce to possibly play out. And we're not swinging for the fences here with this option strategy, but we are looking for a little bit of a 100% gain here. So that's why I kind of selected those just in our example. I know not the best type of examples today, but again, this is just kind of showing you the process and showing you how this kind of can play out with some like warning signs like upcoming earnings and things like that. So we're going to review this order and we're going to hit confirm and send. We are buying the 150 strike call at a $20 limit. We want our 100% gain at $40. We have our stop on the downside, still within our risk parameters of risking just $1,000 here. And everything looks okay to me. So I am going to hit send here. Awesome. And we actually got a fill at the midpoint. Now that's something you won't always see in the live market environment. You'll see that typically in paper money, but those are just kind of the trades that we're going to place today. And of course, in future webcasts, we are going to catch up on the trades that we're placing today and just kind of manage those as we go. So hopefully this gives you a couple ideas on how to search for low volatility stocks with various technical setups. I know we went through just a couple bullish examples today, but you can always change the parameters on that scan to look for more bearish examples there as well for maybe a moving average crossover, or maybe the RSI dipping below 70 on that scan, or maybe just a bearish pattern taking place at a support or resistance level. So many different things that traders can use within these scans. So hopefully that just gives you a little bit of help, a little bit of idea there. But again, stick to your process, stick to your rules. We saw that we went through just looking at our trade size, our trade risk, and following some of our parameters there. But thank you for tuning in today. I just want to give a big thanks to Cam in the chat. He's been helping a lot. The chat's been super busy. Thank you to our production team. Thank you for all of you that are joining today. I had a ton of fun with you. Please follow Cameron and I on X. Cameron is at Cameron May CS. I'm at Rachel-CS. I post a ton of charts, pure technicals really on there with X. And then please like this video if you enjoyed just kind of tuning in today. It'll help your algorithm. It'll help other traders' algorithms as well. And then please also like and subscribe to our Trader Talk Schwab coaching channel. We have a great team of coaches that will cover any type of topic in trading and investing for over 30 hours a week. So please give us a like there and subscribe. But coming up next, we're going to have Getting Started with Technical Analysis with Barb Armstrong. So stay tuned for that, and thank you again.